What interest rate do you have? Currently, 4.5% on my house. Great. That's your note rate. What do people want to do on January 1st, right? And by the way, when rates come down, yeah, it still makes sense to go from 7% to 5.5%. What interest are you paying today? I divided it into the 4,200, which is the total principal and interest payment.
Right.
And I'm at 81% interest. Guys, you hear that? 81% of my mortgage payment today is interest. And then we're going to get you into this program and we're going to eliminate it much quicker because mortgages, in my mind, are necessary for home ownership. Home ownership is good. Okay, we are starting. Here we go. Hello, everybody. I'm Frank Dippold from Velocity of Money. And I got my buddy Rich Schaffer here from, well, couple different cool names: Accelerated Equity Group, United Financial.
Mm-hmm.
I'm gonna kind of frame who I am. We're gonna frame who Rich is, and we're gonna talk about how our products sort of really work hand in hand beautifully. So, what's up, Rich? How you doing, brother?
I'm doing pretty good. I'm loving that. I live on the beach, and I'm looking at your picture there behind you. And of course, I have that view behind me, but you can't see it through that window at the moment. But that's kind of a cool thing. We're on opposite sides of the coast here in Florida.
Yeah, we're both in Florida. I'm on the west coast of Florida. He's on the east coast of Florida. I played baseball at Florida Atlantic, so I know Boca very well.
Mm-hmm.
It was, seemingly 100 years ago when I played baseball there. So anyway, guys, we're going to spend maybe 20 or 30 minutes max. We're going to talk about our products. So let's just jump right in. A little bit about Velocity Money. I've been in the mortgage space for 23 years. Before I was in the mortgage business, I was a real estate investor, bought a couple properties. They went up in value. I thought I was smart. Really, I had nothing to do with it. It just went up in value. And then I got in the mortgage business in 2001. Fast forward all the way to 2018, I wrote material called Velocity of Money, which is a seminar series that shows people that everybody needs 3 pieces of real estate to retire. And Rich is going to tell you a little bit about his background, but what's totally interesting is when I first got in the mortgage business in 2001, I was like, wow, like America's kind of broke. Like where's the savings? Where's the 401k? And so I started to recognize the patterns of how people live their lives. And then we got into the seminar, and having bought and sold over 50 pieces of real estate myself, I created some formulas that showed people a foolproof plan to buy real estate. There's a lot of flip gurus out there. There's a lot of no money down guys out there. To me, that's a lot of nonsense, right? But the one big thing that I saw and I noticed was the financial ineptness. Now, that's not to insult America, right? That's to say that, I've been blessed with the ability to see numbers and understand math and understand real estate and understand mortgage. And having done over $3 billion in loans, I've seen a lot of people and a lot of their spending patterns. And not until I met Rich and his organization did I realize I had a hole in my business, right? And now I'm going to let him tell you a little bit about their side of the business, and then we're going to work to tie this all together. So try to stay till the end, because I think, guys, when I saw his product, it changed my whole perspective on my thinking. So before we give you all the keys to the castle, Rich, why don't you talk a little bit about yourself and your background?
I appreciate that very much, Frank, and it's a pleasure to be here. Yeah, I mean, it's not altogether maybe entirely different than you, but just a little bit of a wrinkle shift. I grew up, born and raised in Michigan, not just outside of Ann Arbor, and moved down here shortly after school in mid-late 90s, and actually got mortgage license in 1996. It was funny. I was clearing out old storage. I think I was mentioning to you the other day, and I ran across all the documents for my original mortgage licensing. And back then it was all paper and pencil, and you had to have 2 licenses to be able to do a first mortgage and a second. It was actually bifurcated in 2 different spaces. That's how long I've been in the space. We used to have daisy wheel printer credit reports back then. No assistant, no processor, 1 computer in the front of the office. It was old school.
You're definitely aging yourself.
Hey, listen, I got in the business young, and but actually I started out in the insurance and security space. And it's an interesting thing because, I don't know, probably not altogether different than you, Frank, but, growing up in the Midwest, in my case, everybody was in the construction industry, the auto industry. Nobody was in finance. I didn't know anybody in finance, anybody that was, savvy about finances. And I had an 8th grade teacher, a math grade teacher, that took a liking to me. And he used to always get the Wall Street Journal, and I would be like, oh, I got to read this, or something. And long story short, he said, you should subscribe to it. I couldn't even understand it, but it made me very curious about money. And the very first thing I ever learned about money was the Rule of 72, the banking Rule of 72, which lends itself into a lot of what you teach in terms of that refers to the time value of money and compounding, but the velocity of money, right? The use and the leverage of money. So fast forwarding the many years after being in the insurance and security space, I only got a mortgage license, Frank, for one particular reason. Because the number one reason that people weren't adequately insured or properly and aggressively enough invested for college, retirement, et cetera, was because they didn't have the money. So I thought if I could restructure the biggest debt they had and immediately make those dollars available before they touched their hands, before they spent them, we could redirect them to accomplish those goals. And that worked very, very well for us. I was very proud of that. We had a very holistic financial practice. But there was a common denominator, Frank, that I kept noticing over and over again, which is that I would do this whole great comprehensive plan and a lot of education, a lot of client service. And they'd come back 2-3 years later, like knocking on my door, and they were back in debt. And they're like, fix us. And I was like, your home isn't any ATM, And what ended up happening is I had a business partner at the time that thought, hey, that's great. You're getting more loans. And I said, but somehow I'm not helping the client. This isn't working the way I thought. It really did frustrate me a lot. And in 2006, I came across the precursor to the technology that we launch and market now. And it actually was showing how you could leverage the use of an offset account. We were using a line of credit at that time, but coupled with a web-based platform that would provide the financial guidance, right? We call it financial GPS effectively, right? And Frank, I was immediately smitten because I knew that the number one reason my clients didn't stay on track is I couldn't go home with them. Not that they would want me to, but the whole point is that they would go home or they'd see a shiny new car on the highway or a commercial for a trip to Disney, and that whole financial plan went right out the window. Mm-hmm. And so I thought, wow, if we could create virtual financial coaching, that would be a game over experience. So long story short of that is the product is called the MoneyMax account, and it is probably the single most comprehensive money management, cash flow management, interest cancellation, debt elimination, and wealth building tool I've ever seen, because it really gets down to the core of how money actually works and how interest is actually calculated and things of that nature. So anxious to get into more detail about that, but it's really come full circle in my life in a way where now I feel like I'm back into the financial coaching and education sides of things, which honestly was always my passion from the start.
I love it. All right, so I'm going to give everybody the first punch because this is what blew me away literally 3 weeks ago, and I haven't slept since. Guys, we have amortization in America, and I've been selling this because mortgages in my mind are necessary for home ownership. Home ownership is good. So at my Velocity Money seminars, I teach people how to be first-time homebuyers. I also teach people how to take certain homes and turn them into investment properties. And the theory is use the bank's money to buy the property, use the tenant's money to pay off the property. Now that's not zero down, but it might be 3.5% down. You live in the property for 1 year and then you turn it into a rental and you have somebody else pay off the mortgage. Then with the proper cash flow, because we have a formula that we call the Power 4, which teaches people when the right property is to buy and when you don't buy it, you're supposed to take extra cash flow and pay it off sooner. But here's the problem. People don't do it. Now, I just want to rewind before I give you guys the first punch. And it's going to be a nice punch. You're going to really ponder on this. But back in 2007,
that's not very often. It's a good punch. That's not usually something that happens, right? I've never had a good punch before.
This is going to be a good one. Back in 2007, I didn't even tell you this. I used to do seminars. This will blow people away too. To take interest-only loans, because they were the same rate pretty much as the 30-year fixed loans. By the way, like Europe and most of the world has interest-only loans, and I'll tell you the difference in a second. Take interest-only loans and save the difference of the money. Because if you save the difference of the money and that money compounds year over year, rules of 72, that money compounding outpaces the cost of the mortgage. So here's a trick question for everybody. Would you ever take an interest rate of 5%, borrow at 5%, and then take that money and earn 4%? And of course, the whole audience says, no, I would never do that. But if you think about the theory of interest-only loans, Interest only is simple interest, right? So it's interest rate divided by 12, right? Times loan amount. And as you pay it down, your payment goes down. Versus fixed amortization, which is mostly interest in the beginning, and then you pay a little bit more principal year over year. So back to my 5 versus 4. 4, you guys can put it on an Excel spreadsheet. The math works. $200,000, 4% year over year compounding grows and accelerates at a faster pace than 5% simple interest. So at some point, you could literally take the difference of that principal payment, put it away, and earn more money than it's costing theoretically, because it's compounding versus simple. Now, that would literally take people an hour, and we would usually go to the bar afterwards. I remember my one attorney friend said to me, dude, it's like, you blew me away. He's like, I can't do it. But here's the problem with that seminar. Number one, 2008 happened. The world blew up. Interest-only loans became very expensive. So they became an obsolete product. Number two, nobody was saving the difference of the money.
That's right.
So here's the first punch. Ready? Rich said this to me. What interest rate do you have currently? Okay, well, I don't know. I have 4.5% on my house. Great. That's your note rate. What interest are you paying today? Meaning, if you look at an amortization schedule, and we just bought this house in Florida a little over a year ago, an amortization schedule, I'll give you my numbers. Right now, my interest is $3,500 a month, and my principal is about $625 a month. So $3,500 is interest, $625 is principal. The other day, I took the $625 and I divided it into the $3,500, I didn't. I divided it into the $4,200, which is the total principal and interest payment.
Right.
And I'm at 81% interest. Guys, you hear that?
Interest volume.
I'm at 81% of my mortgage payment today is interest. So now, Rich's product, if I butcher this, correct me, is an algorithm, is a system that will take your income, will take your budget, and will allow you guys, with advice, pay this week towards your mortgage, or pay this towards your credit card debt. And it's accelerating the payoff tremendously, because I don't know about you guys, but who wants to be paying 81% interest? And by the way, if you're in the first 10 years of a loan, even 15, you're paying anywhere from 50 to 90% interest in the first 10 or 15 years of that loan. So why, and then I'm going to let Rich explain his product better than me, but why I feel like I didn't have the final product in my arsenal, right? We do mortgage, we do marketing for mortgage real estate, and I show people how to buy 3 pieces of real estate. Now, third product, especially if it's an investment property and you're getting money from tenants, will just tell you what to do to take 30-year mortgages down to what, Rich? 7 to 10? Something like that?
Yeah, generally in that space. You hit most of the points. I'll tell you, here's the real secret sauce. But I want to say something first. Take someone like Frank, for those listening. Experienced, knowledgeable veteran in the financial space, been in the mortgage industry for a long time, done a lot of real estate investing, right? Obviously, savvy, knowledgeable, financial professional, no question about it. But even at that, ironically, most of the people in our industry don't really have a true understanding of the actual cost of debt service, right? So we focus, you alluded to this a second ago, there's note rate. Let's set that aside for a second. The note rate is simply what dictates your payment. However, it's all about interest volume. What is the true cost of that debt service, right? So there used to be the example, to piggyback on what you said a minute ago, where somebody might be saying, oh, well, I have a 4% loan, to use the example you used, and I can invest money and make 6% on that. So I'm 2% ahead. That's simply not true. And here's why. Because 6 ain't 6 and 4 ain't 4. 6 is going to incur cost, fees, loads, expenses, potential tax implications, etc. And 4 ain't 4 because it's not the interest rate. It's how the interest is calculated, how the finance charges are assessed, and how and when the payment applies. That is what determines true debt service cost or interest volume. Our whole focus is effective interest. How much are you effectively paying against the loan or the interest rate that you're actually being assessed. So here's the nature of what happens. And I can't help but relate this to a very commonly known, technology that people use every day. Frank, I mean, what's really the difference between a map and GPS? They're both using navigational coordinates. One is automated, one is manual. Now, if you had a map as an example, right, and you said, I'm here, right, and now I'm here. Well, you're closer, but how much closer? What does that represent in terms of miles or minutes? Nobody knows. GPS is going to tell you how many more miles that represents or how many more minutes. But most importantly, and you said this as well a minute ago, people don't follow through, right? I'm going to be leaving to go to Orlando this afternoon, a little daddy-daughter retreat, a little camping retreat. I know exactly where I'm going, but I'm still going to click on GPS. Why? Well, because there's this thing in life called car accidents, detours, right? I could get a flat tire, God forbid. I might stop and go to the bathroom or get gas or get something to eat. There might be a railroad crossing. There might be construction. Who knows? Or there might be a speed trap ahead, whatever the case is, right? What is GPS going to do? Recalculate, 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 because life is not a straight line. Now, going back to all the years I was a financial planner, Frank, what do you think the number one problem was when I would put together a comprehensive financial plan? Well, life, people, human behavior, right? You're making this much money. You need to save this much. Well, what's the problem with that? Well, income changes all the time, especially for self-employed people like you and myself. But even those that are salaried, could they get laid off? Sure. Could they get a raise? Hopefully. Could they get, a tax refund? Yes. So, and inflation is a factor in terms of buying power. So the actual impact of earnings changes all the time. But the other factor that changes until the day we die are expenses. One kid needs braces. The other one needs glasses. You fix the washer and the dryer breaks. You fix the transmission, you need new brakes. And you know when that's going to stop? Never. So we never actually know the impact of what we're doing in terms of spending and receiving at any given moment. And that's far more comprehensive than a budget. So it's all a matter of saying GPS has one goal. How do we get you from point A to point B as quickly as possible?
Mm-hmm.
And you can customize the route, right? Shortest route, fastest route, avoid toll roads, highways. Our system has one focus. How do we get you out of debt as fast as humanly and mathematically and algorithmically possible? So the system focuses on four primary elements: strategic payoff. In other words, knowing exactly what to pay to the penny, to the dollar, to the day. Number two is interest float. How do we now fully maximize the leverage of interest float to your advantage instead of the bank's? Number three, interest accumulation. Now, by the way, 2-3 years ago, mortgage rates were 2 or 3%, and you will only get maybe 0.25% on a savings account. Well, now you've got rates that are 6 and 7%, and guess what? You can get 3, 4, 5% on savings. So incremental accumulation does add up. But last but not least, Frank, this is by far and away the most relevant and the one that people understand the least: interest cancellation. How do we fundamentally cancel interest you would otherwise pay? Now, you were talking about amortization schedules a minute ago, Frank. What most people don't realize is amortization schedules are not actually based on payments. They're based on balance points. It just so happens it takes a given number of payments, principal interest, to reach that balance point. But when you can leverage additional dollars and you can systematically apply them towards that principal, you accelerate that curve to a point in the future where that balance is less, and therefore you eliminate every single principal interest payment you would have paid. So that means you get an exponential impact of what you spend. Somebody could put $3,000, $4,000, $5,000 to principal systematically. Their balance would lower that much, but they might have eliminated $6,000, $8,000, $10,000 in interest, foregone forever. So when you really start understanding how to be able to manipulate the impact of that, it completely changes the game. And as a result, people can typically take every single debt they have, including their mortgage, and pay them off in roughly a third of the time, saving tens, if not hundreds of thousands of dollars of interest. And, really, Frank, that's a game changer when you talk about people wanting to get better and control their finances, get out of debt quicker, save money and interest, because then now they have other opportunities in terms of investments, real estate, et cetera.
Yeah. And it goes back to where my heart is, right? Because when I looked at the problem in America, my seminar started with that. Problem in America is we carry credit card debt. We never we never really invest money. If anything, while we're carrying credit card debt, people might throw a little extra money towards a 30-year fixed mortgage, which is good in theory. But like you just said, it's kind of like driving. You don't really know where you're going. You're just driving and you're making a right turn because you think making a right turn is the right way to go. And one of the other things you said to me is, what do people want to do on January 1st, right? They want to get in physical fitness and financial fitness.
Fitness and finance.
Fitness and finance. So think about that, guys. If you really want to work hard, you go to a trainer, or at least follow a meal plan, or at least do something. Right now, this week I started 75 hard. I've done it once before.
Oh, that's intense.
Yeah, I looked in the mirror. I was like, okay, I have enough of this, and I'm doing the Whole30 diet, and I'm on day 5, and I'm exhausted, and I feel miserable, and I look miserable. But I know in 60 days, if I don't fail, or 75 days, if I don't fail, I'll look better.
Yeah, it's 75 days, Frank, not 60.
I know. 75. So think about this. I always said how you affect your liabilities, meaning we're doing the mortgage. We look at people forensically when we do their mortgage. And I see everything. Obviously, you've done a ton of mortgages too. How we affect their liabilities will affect whether they have money or not. Now, the financial planners, a lot of these guys, they want $1 million. They want a client with $1 million because that's the only way they can make any money. But what about the 99% of America who might make a few dollars, have a decent income, college, kids, expenses, cars break down, mortgage interest at 80%, right? There's so few roadmaps. And I'm looking at this thing, or so few navigation system, which you guys have. I'm looking at this going, oh my gosh, we can show people how to get their first piece of real estate, then parlay it into other pieces of real estate. But then imagine if we took this tool, guys, and you guys were getting debt free and paying off your first mortgage in 7 to 10 years. And imagine if your second property or third property obviously is being paid by tenants, and you get those paid off, and then your tenants with the cash flow is helping you pay your primary bills at home.
Right.
That's the American dream. But America thinks that only the rich people could buy real estate. My goal is to help 10,000 everyday Americans buy real estate. It's actually not as hard as you think. Now with your tool, we can then give them a navigation tool to get that debt eliminated. Because I have a few friends that bought real estate early, and they were very, very frugal, didn't spend, just wanted to pay off the mortgages. And I mean, these guys are killing it. They got 50, 60,000 a month in cash flow because they got their first 2 properties paid off.
Yep.
They would buy another property with the equity. And I did the same thing. The problem is in 2005, 6, 7, I got greedy and prideful, and I started buying real estate for the wrong reasons,
right?
Which is what then parlayed my knowledge into the formula, because it's not about appreciation. It's not about buying near a beach. It's all about cash flow.
Mm-hmm.
You have the cash flow, then you're going to have the tool to pay this thing off. Now, here's one key point that I want you to hit on, because everybody might be sitting here going, well, I don't have an extra $4,000 a month to pay towards the mortgage or whatever. Talk about sometimes, Rich, how it doesn't even have to be that much money. Right? There could be a small margin of money, meaning the couple could make $6,000 a month and have, $5,200 in bills, and still the tool works. Talk about that.
100%. Well, this is a huge misnomer, and I'm going to hit on something you said because it's really core, and it's one of the reasons we're in such alignment. Is that, growing up without knowing really anybody that had any money, we are told, oh, it takes money to make money. Certainly helps, but we create the mentality that unless you have a lot of money, you're boxed out. You don't really have the opportunity to become successful financially and get ahead. And it's simply not true. It is not true. In fact, we literally have had countless examples where we could help somebody with as little as $1 a month of positive net discretionary cash flow. And the reason that is because it's not just the net dollars available. It's how to be able to effectively leverage every dollar they earn every day they have it until they spend it. So let's think about how banks make money. This is an incredibly core tenet of this whole platform. And I'm not vilifying the banks, but imitation is the greatest form of flattery. There is a reason that banks are the biggest building in any city, in any state, in any country in the world. And it's two reasons. One, it's the golden rule, but it's not the one you learn in church. It's he who has the gold makes the rules. Okay. Possession is 9/10. Number two, they know what to do with the money, but it's never stagnant to the point of your whole channel. They're all about maximizing the velocity and the volume and the use of that money. So, simple example, when people deposit money in the bank, let's say it's $6,000 to the example you used, right? And they have $4,000 or $5,000 of fixed expenses. They spend another $100, $200 a month on going out to dinner, going to the movies. At the end of the month, they might only have $200, $300, $400, $500 left. So the average person, Frank, thinks, well, what difference does it make if I earn any interest on, a few $100s? That is not how banks make money. They're making money on the entire $6,000 and any remaining portion of it every single day until you spend it. So every dollar has to have three jobs. And I want everybody to remember this particular part of the conversation. The dollar has to either be used to cancel interest, to eliminate debt, or to save and accumulate interest and wealth. So it's all about putting the money actively to work. We think passively. It's about actively. We think two-dimensionally, right? 1 + 1, addition and subtraction. This is three-dimensional. It's exponential. And we need to start thinking from that standpoint. I always think about the Wizard of Oz, that all the characters thought it was this almighty Oz. And it was really just some guy behind a curtain pulling levers, right? And that's really very much how the financial system worked, which is why it's largely rigged against the average person. Mm-hmm. We've been taught, Frank, to become loaners of our money, not owners of our money. We get a tax refund and we do a happy dance, instead of realizing all we really did was overpay our taxes every single week for a year, mm-hmm. and got absolutely no interest earned on that money that we got returned to us. Escrows, the same situation. Obviously, in many cases, people have to have escrows, but even when they don't, does the bank give you any interest for the use of your thousands, if not tens of thousands of dollars throughout the course of the year? No. And 91% of all bank accounts are non-interest bearing accounts for the very reason I just said. So we become so conditioned into thinking you don't know what to do, just let us use your money. And they're becoming obviously incredibly wealthy doing it. Our whole focus is how do we turn the table on the banks and help the average person bank like a bank at the push of a button.
Amen. And the good news is, guys, you're probably sitting here going, wow, I can't figure this out. Well, clearly I can't figure it out. It's software, right? So we're gonna, at the end, we're gonna tell you the next date. If you know the next date of a webinar, we can get people invited, all that stuff. But the thing is, the software does it, right? So
yes,
it's so true that when you are earning money on your money, then you're gonna allocate it properly towards paying down this debt. And it is absolutely a game changer because
it does all the thinking for you.
Yeah. The American dream is to pay off their mortgage. And I always said to people, I want you to pay off your mortgage too, but at what expense? Meaning if you don't have that navigation tool and you're taking every dime of your cash flow and you're putting it into the mortgage, and then you have no money for a rainy day or you have credit card debt, that's no good either.
Sure.
But the other side of this is if we could effectively get rid of our debt sooner, live with more cash flow, it's going to keep us lighter, healthier, happier, right? And then if you feel really good about where your cash position is or your debt reduction is, I'll help you buy more real estate because I do believe real estate is a very big component of retirement assets because it's the gift that keeps on giving. Meaning, if you have your real estate paid off, what I teach people is we're going to put it in a trust. We're going to leave it for the family. We're not going to ever let the family sell it, but we're going to let the family benefit from the cash flow. Because think about it. Rents have doubled in the last 12 years. If you had real estate paid off generationally, a $3,000 rent right now, 100 years from now, might be $12,000 a month. And that asset just becomes a cash cow. So my job, and obviously Rich's job, is to show you guys these tools, which will literally be a game changer in your life, because he and I both tell you, I was 22 years old like 2 seconds ago, right? And this year,
ain't that the truth, man?
Yeah, this year is my high school 35-year reunion. It's ridiculous. My kids say to me, Dad, you sound so old when you say that. And I'm like, wait, like I was young and cool like yesterday, but clearly not now. But
Hey, we're not young anymore. We're still cool, Frank. I don't care
yeah,
what they say.
I don't know. Yeah, maybe in our own minds.
Well, look
But
at when you think about this. This is a good example. Okay, how many people do you think know how to send a text or attach a picture? You see, everybody's on social media now. Everybody's on some sort of virtual, video platform. If you can know how to turn right in 200 feet following GPS, they can use our program
right.
because it's going to tell you exactly to the penny to the day exactly what to do. So it's totally automated. The system does all the mathematical calculations and thinking for you. So it's literally as easy to follow as GPS is.
Beautiful. Okay, we're gonna wrap up. There's so much more. Very exciting. They have upcoming. What do you do? Webinars every 2 weeks?
Yeah, we do it every week. Every week.
Every week.
It's Tuesday at 8 o'clock Central or 8 o'clock Eastern. I'm sorry. And we do a free informational webinar talking exactly about how this program works, how this strategy works. Obviously, there's no cost whatsoever. And for those that want to get a free savings report analysis done, it's complimentary. There's no obligation for that to see whether or not it's something that could benefit them. But quite frankly, they got nothing to lose but years and potentially tens, if not hundreds of thousands of dollars of interest. And we're that confident of it. We guarantee the results of the program. So not many things can say that in this day and age.
Yeah, the link below is going to have my contact information, Rich's contact information,
Yep.
and the next upcoming webinar, which I think everybody should jump on because game changer. If you're paying 81% interest, that's too much, clearly, right? So don't focus on your note rate, focus on, and if you want us to show
Number
you,
third.
Yeah. And by the way, when rates come down, right? Because I own a mortgage company, yeah, it still makes sense to go from 7% to 5.5%. And then we're going to get you into this program and we're going to eliminate it much quicker.
Absolutely.
So hopefully he wasn't too intelligent for you. I know I wasn't too intelligent for you. I'm telling you guys, I believe in this because you don't want to wake up and be 65, 70 years old, still having mortgages and still having debt.
That's right.
We want to be happy in retirement and we want to have cash flow so that we can travel the world, go to Italy with our wives and our family. And you don't have to make $1 million a year to do that. It's just about managing your debt properly.
Yep. I appreciate it, Frank. That's great stuff. It's great to be on the show today and looking forward to providing a lot of education and training for the folks that follow you in the future. I think that we're going to fundamentally change the way that people look at their finances and manage their money in the future and give people a lot of hope that they're not just running on an endless treadmill and they've actually got some direction and a goal that they can achieve. And I think that's pretty exciting.
I agree. Amen. I love it. All right, brother. Thanks, Rich. Thanks, everybody. We'll see you all soon.